Okay, students, I really welcome all of you in the first live revision class of FM, September 2024. Since it's a first live revision class, so obviously this class will be very short. Slowly and gradually, the timing of the live revision class will increase. And what is the agenda of the live revision classes? Basically, in the live revision classes, we are going to complete the entire course. Obviously, all the concepts we are going to revise. Plus, we'll be doing a practice of the recent questions. Obviously, majority of the question which we'll be discussing in these live revision classes, they will be new questions. They're not already in the pre-recorded classes. So in this way, actually, your question bank will increase. So FM first live revision class, September 2024, we are starting from investment appraisal. Investment appraisal. The first thing which you really need to know is actually investment appraisal is a long-term decision. It's not a short-term decision. Short-term decision is we make short-term decision in working capital management. When we say investment appraisal, it's a long-term decision. Okay. In financial management, in investment appraisal, what are the techniques which you need to know in order to pass this paper? Obviously, the first one is NPV, net present value. Second is IRR, internal rate of return. Third is the payback period. And can I say in payback, basically you have to know both the payback. Simple payback period and discounted payback period. Simple payback does not consider time value of money and discounted payback considers time value of money. Accounting rate of return. Another name is ROC, return on capital employed. So basically in financial management and investment appraisal, there are 4 techniques which you need to know because when an entity wants to make an investment in any project, so obviously they have to use investment appraisal techniques. Out of these 4 techniques, the superior one is NPV, net present value. Okay. Now, when we say investment appraisal, so simply if there is one project in front of you, am I audible to other students, please? Can you please reply in the chat box? One student is having an issue of the sound. No, please write. Am I audible? You people are writing yes. It will make them confused to that is mode. Simply write you are not having any yes. I'm audible. Okay, so that's great. No, it's okay. So please just write in the chat box to that student, please rejoin. Simply that student should rejoin. Okay. So in investment appraisal, basically when we say appraisal, if there's a single project in front of you, so either you are going to accept the project or reject the project. Appraisal. If there's a single project, either you will accept or reject. If you have 10 projects in front of you and you need to opt only one, then obviously out of 10, you are going to opt the project which gives you the highest NPV. So if there's a single project, if that project gives you a positive NPV, you are going to accept that project. If there are 10 projects out of 10, you just need to opt one. Obviously, I'm going to opt the project which gives us the positive NPV. Okay, now the first thing which you need to know is there are principles, they are rules for calculating NPV. So you should be having a really good grip on the rules of calculating, principles of calculating NPV. So what are the basic principles of calculating NPV? Basic principles of calculating, let's say, NPV. Number one, when we calculate NPV, you will have to only consider relevant cash flows. Only relevant cash flows are considered. Only relevant cash flows are considered. Only relevant cash flows are considered. Now, what do you mean by relevant cash flows? Now, let me explain that. Number one point. When we say relevant cash flows, so future cost, simply cost yet to be incurred, is relevant. So future cost is relevant. The cost which is still to be incurred, which you have not incurred yet, that is relevant. Another example. Future earnings from the project are relevant. Future earnings from the project are relevant. Third, either there is inflow or outflow. It should be because of the project. Repeat, either there is going to be cash inflow or cash outflow. It should be because of the project. So it means it must be caused by the project. Caused by the project. When we say caused by the project, for example, we are talking about incremental cash flows. We are talking about opportunity cost. Obviously, because of the project, if I have to bear the opportunity cost, that is very much relevant for me. We cannot ignore the opportunity cost. We cannot ignore the opportunity cost. So, for example, incremental cash flows, opportunity cost. Fourth, that is, when we calculate NPV, you just need to consider cash flows, except is the tax depreciation. Only consider. You can take this by definition. By definition, it must be a cash flow. Except tax depreciation. Another name for the tax depreciation is capital allowance. By definition, it must be a cash flow except tax depreciation. Another name for the tax depreciation is capital allowance. Now listen. Tax depreciation itself, it is not a cash outflow. Tax depreciation, capital allowance itself, they are not cash outflows, but due to capital allowances, due to tax depreciation, organizations, they save tax. Due to tax depreciation, due to capital allowances, organization, they save tax. That is why they are relevant. Repeat. When we say by definition, it must be a cash flow, except is the tax depreciation. Another name for the tax depreciation is capital allowance. Obviously, tax depreciation, or you can say capital allowance, they are not cash outflows, but you cannot ignore them. Why we can't ignore them? Because tax depreciation saves the tax. Capital allowances, they save the tax. That is why they are relevant, even though they're not cash flows. Okay. Now, another point. While calculating NPV, we do not consider dividend payment, interest payment as relevant cash flows. Why? Because impact of dividend and interest is already incorporated to the cost of capital. Now, since the interest payment, dividend payment impact is already incorporated to the cost of capital, if you consider interest payment, dividend payment as relevant cash flows also while calculating NPV, then there will be a double counting, because already you have considered that into your cost of capital. If you are considering them again in your NPV calculation, so there will be double counting. So simply interest payments and dividend payments are not relevant cash flows because effect of these payment already incorporated to cost of capital. 6 point. Past cost is the sunk cost. It is irrelevant. Past cost, that is sunk cost, is irrelevant. Because the cost which has incurred in the past, either today you make investment or you're not making investment, it cannot be reverted back. You cannot get it back, that cost which you have already incurred. For example, R&D, research and development, which R&D which you have incurred before starting the project. R&D which you have incurred before starting the project, it is irrelevant now. But if you are solving a question and the examiner says, after making an investment, you have to carry out R&D, then R&D becomes relevant. If you have to carry out R&D after making an investment. The concept is, if you have conducted R&D before making the investment, then such R&D is irrelevant. But if you have to incur R&D after making an investment, then it becomes relevant. If you have spent the money on marketing before starting the project, then such marketing expense becomes irrelevant because you have incurred the marketing expenditure before starting the project. But if the question says after making the investment, you have to incur, entity will have to incur the marketing cost, then such marketing expenditure becomes relevant. Okay. 7th. Committed fixed cost is irrelevant. Committed fixed cost is irrelevant. What examples of committed fixed cost? Actually, committed fixed cost means you have to incur the cost in the present as well as in the future. You have to incur the cost in the present as well as in the future, but still it is irrelevant. The example is, for example, a business premises which is already on rent. The business premises which is already on rent, obviously you are paying a rent in the present, you will be paying a rent in the future as well. But that is a committed fixed cost. For example, there is a business premises which is already on rent, and let's say in that premises you are already running a project A. Assuming the premises is so big that project B can also be accommodated in that premises. Can I say, if the project B can be accommodated in to the same premises, obviously rent will not increase. The rent will remain same. So either the new project you are going to accommodate in the same premises or not, it has no effect on the rent payment. So that is why we say the committed fixed cost is irrelevant, even though you will be incurring this cost in the present as well as in the future. The example is business premises which is already on rent. So for example, business premises which is already on rent. Obviously, additional fixed cost is relevant. Look at the name, additional. Sometimes examiner uses the word incremental. Additional fixed cost, incremental fixed cost is relevant. Additional fixed cost, incremental fixed cost, project specific fixed cost is relevant. So if your examiner says there's an additional fixed cost, there's going to be incremental fixed cost. So obviously it is very much relevant. Okay. So you should be having a really good idea about the first principle, the first rule, that is when we calculate NPV, when we calculate, let's say, IRR, when we calculate discounted payback period, we only consider relevant cash flows. And the relevant means future cost, the cost is still to be incurred is relevant, future earning from the project is relevant. So what, either it is inflow or outflow, it must be caused by the project. For example, incremental cash flow, opportunity cost. By definition, it must be a cash flow except the tax depreciation, even though tax depreciation is not a cash flow, it's not a cash outflow. Another name for the tax depreciation is capital allowance, even though they're not cash outflows, but still, due to tax depreciation, due to capital allowance, what happens? You are going to save the tax. Since they result in tax saving, that is why we do consider them. Interest payment, dividend payment impact is already considered in the cost of capital. That is why we don't take them as relevant cash flows while calculating NPV. Because if you consider them as relevant cash flows while calculating NPV, then there will be a double counting. Past cost, sunk cost is irrelevant. The cost which we have incurred in the past is irrelevant because either you are making investment today or not, it will have no effect on your on the cost which you have already incurred in the past. Committed fixed cost is irrelevant. The example is, let's say, business premises which is already on rent. For example, the premises is so big that in the same premises, you can accommodate the new project. So either you are going to accommodate the new project or not. It will have no impact on rent. If your examiner says the given fixed cost is the additional fixed cost, it is an incremental fixed cost. So obviously additional fixed cost, incremental fixed cost is relevant. Existing fixed overhead, they are irrelevant. Existing fixed overheads are irrelevant. Why they are irrelevant? Because they are not incremental, they are existing. So existing fixed overheads are irrelevant. There's a possibility that examiner can use a few technical terms instead of using existing fixed overheads. Examiner can use few technical terms. So what are the possible technical terms which examiner can use for existing fixed overheads? A, examiner can use allocated overheads. Examiner can use the word apportion overhead. Allocated overheads, apportion overheads. Examiner can use the word applied overheads. Examiner can use the word applied overheads. Examiner can use the word ABC allocation, activity-based cost allocation. We should know that either company is using ABC allocation or absorption costing. In both the ways, only the difference you will see, the difference will be in the allocation process, but total overheads, they remain same. So even the examiner uses the word ABC allocation, it is irrelevant. If the examiner uses the word absorbed overheads, it's still irrelevant. Absorbed overheads. So these are the 5 terms which can be used instead of using the word existing fixed overhead. So examiner can use either allocated overheads, apportion overheads, applied overheads, ABC allocation, absorbed overheads. All are irrelevant because they are existing overheads, they are not incremental. So this is the first rule, that is only relevant cash flows are considered. Now, second, when we say cash flows, so basically there are 2 types of cash flows. One is real cash flow. The second is nominal cash flow. For nominal cash flow, examiner can use the term monetary cash flow. One more possibility, examiner can use the word money cash flow. Actually, real cash flows means without inflation. Real means without inflation. Nominal means with inflation. Very important concept is if you have been given real cash flows. If the cash flows are real, then cost of capital must be real. Then cost of capital has to be real. If the cash flows are nominal, then cost of capital will also be nominal. So there are 2 possible cash flows. One is real cash flow, another is nominal cash flow. Real means without inflation. Nominal, another name is monetary cash flow, another possible name is money cash flow. Simply nominal means with inflation. If the cash flows are real, then cost of capital has to be real. If the cash flows are nominal, then cost of capital will be nominal. Okay. Now, you need to learn how to convert real cash flows to nominal. Then obviously later on you need to learn one more thing. If nominal cash flows are given, an examiner is asking you to calculate NPV in real terms. So obviously you should know that how do we convert nominal cash flows to real. But first we are learning how to convert real cash flows to nominal. So right now we are discussing how to convert. So real cash flows converting to nominal. Obviously, real means without inflation. Nominal means with inflation. So right now we are discussing how do we convert real cash flows to nominal. Number one, if the examiner has written current price, another possible name is real term price. Another possibility is year zero price. Another possibility is present day price. Another possibility. Sometimes what examiner does, examiner simply writes that above cash flows are without considering the inflation. Another possible term is above cash flows are without inflation. Above cash flows are without inflation. If any one of the term is used, then inflation will be incorporated from the first year. Inflation will be incorporated from the first year. Because whatever all the five terms means price at time zero. So obviously inflation is not going to come at time zero. It will come from time one, T1. Second possibility, if examiner says first year price, if examiner has given you the first year price, then inflation will be considered, will be incorporated from the second year. Because first year price means inflation of the first year is already considered. First year price means inflation of the first year is already considered. So if examiner says first year price, first year price means inflation will be incorporated from second year. Because first year price means inflation of the first year is already incorporated. Now, let's see. Question 1. T1, T2, T3. Current prices. 100, 100 and 100. Inflation per annum is 10%. We are simply required to calculate nominal price. Simply 1.1, you will get 110. Then 1.1 power 2. So can anyone use the calculator? Because right now I don't have a calculator in front of me. Let me try 100 into 1.1. Where's the... Okay, great. Scientific calculator, Can anyone use the calculator, please, quickly? Or should I go and bring the calculator? I think it is 121. Please check. Yes or no? Okay. Now, what about the third one? 133.1. The third one is 133.1. Great. Let's go for another example. Another example, time. T1, T2, T3, T4. Average current price. 130, 142, 136.5, 147. Inflation per annum is, let's say, 12%. Nominal price. I really want every one of you, please attempt this question, then we'll be solving together as well. Okay, guys, what is the answer? Can I say 1.12? 130 into 1.12? I'm getting 145.6. Then 1.12 power is going to be 2. 142, 1.12. I'm getting 178.1248. Leave that 178. Okay. 1.12 power 3. So why we add 1 in it? Please, can you see this? It is 130. Let's take 12% of 130. Let's take 12% of 130. It is 15.6. Add them, please. Can you see this, please? Is it clear now? Did you get the same result we are getting by multiplying like this? Yes or no? It's just a simple maths. So please, at least this much maths, everyone should know that. And I strongly believe we love maths. Okay. Now the third one, 136.5. The power is going to be 1.12 power 3. Let's see what are we getting. Please, you people should also check. 136.5 multiplied by 1.12 and then power 3. I'm getting 191.77, so I want to make it 192. Can any other student can confirm this, please? Is it right? Yes or no? Please, students. Is it correct or no? It's correct. Everyone has the same result. That's great. The last one. 1.12 power 4. 147, 1.12 power 4. I'm getting 231.3 something. Leave that 231. Now let's see one more example. T1, T2, T3, T4. Current average price. Let's say it is 120, 126.5, 124.5, 130. Inflation per annum. It is 18%, 15%, 12%, and 10%. I want every one of you to attempt this question and please calculate the nominal prices. Please, everyone, attempt this question. 1.18, 120 into 1.18. It is 141.6. Now, since inflation rates are different every year, so you cannot use the power methodology which we have used in the previous two examples. In the second year, it's going to be 1.18 into 1.15. So 126.5 into 1.18 into 1.15. I'm getting 171.66. 1.18, 1.15, 1.12. So 124.5 multiplied by 1.18 into 1.15 into 1.12. Please, students, do check. I'm getting 189.22. 1.18, 1.15, 1.12, 1.1. So 130 into 1.18 into 1.15 into 1.12 into 1.1. 217.33. That's great. We got the same results. I hope that everyone has understood this. How do we convert real cash flows to the nominal? Let me repeat. Actually, today's class agenda was very simple. Since it's the first class, I did mention earlier, it's going to be very small class, but obviously after that, the timing of the class will increase. And we are going to cover the entire financial management in our live revision classes. We have started from the same topic, investment appraisal. We'll be following the same sequence, which is in our pre-recorded lectures. But I would request each one of you and other students also, they have not joined today's class, try to complete the lectures as soon as possible so that you can have more time for the revision. And another point is, please do not skip live revision classes. You have to attend all the live revision classes because, see, live revision classes, they are going to make the difference. You might have noticed I have explained each and everything and with the more or less the same speed which we have in our pre-recorded lectures. So we are going to cover entire financial management conceptually. Plus, we'll be doing the new questions which are not in the pre-recorded lectures. But I really want every one of you to join and attend each and every live revision class. So in today's class, I just wanted to give you a little bit flavor of the live revision class. And plus, I really want every one of you try to complete your pre-recorded lectures as soon as possible. So thank you very much. Inshallah. From next week onwards, the timing of the class will definitely increase. So it's just a first class, a little bit flavor of the revision class I've just given you. So thank you very much that you people have attended this class. And I really want you to give the feedback in your relevant WhatsApp groups. Your feedback obviously does not only motivate the teacher, it also motivates other students so that they can also join the upcoming classes. So thank you very much. Have a nice life. See you all inshallah in the next live revision class. And this revision class will be shared in your will be uploaded on WhatsApp, will be uploaded on the portal with this PDF document as well.